Hello and welcome to the Weekend Investing Daily Byte of 26th of August. And what a day it was. Nifty flaring up a couple of 100 points and re climbing the 25K mountain. And the markets now seem to be completely satisfied with the fact that rate cuts are coming and that 0.5% is sort of baked in, maybe even more. Mid of September, we will know that. So the market continues to chug along. However, rate cuts historically have not been so great for the markets with a lag. So post the rate cut cycle starting after a quarter or two, there may be some lag in the market. Markets may top out for some time. That has been the past history. Some users reached out to me last week saying that why don't you show what gold has done whenever rate cuts have happened. So I got some data on that today. But first, let's see what Nifty has done today. We will talk about rate cuts, whether it will ignite gold or not later on. Of course, you need to subscribe to the channel to come to know of the new videos in time. Where are the markets headed? So markets crossed the 25,000 barrier today marginally. It did go slightly higher till 25043, but succumbed back to near 25,000, near large round figures, just like Sachin and Sunil. There is nervousness, and today was another such day near 25,000. But I think now we are almost there in sense that we did go to Mount 25K beginning of August. We had a very sharp fall. The reason or the excuse at that time was yen carry trade. We have recovered back. It has taken less than a month to recover back. I think we are all set for going up higher. So no complaints on Nifty 0.76% up. Nifty Junior is totally flat today. It opened slightly gap up, stayed there, 0.5% up for the day, just at the cusp of breaking out. Again, waiting along with Nifty, I suppose, on that front. Mid caps also similar to Junior, completely flat, opened slightly gap up and stayed there. So the previous days bearish engulfing candle that we had seen did not follow through. And above that Friday's candle, I think the bulls will have an upper hand. Plus 0.52% on mid caps. Small caps gapped up to a new high, could not sustain there, but still closed at a new all-time high at 0.41%. Small caps seem to be suggesting that they are going to be leading this rally now going forward. Bank Nifty tried to get out of this 51,150 mark, uh, gave up most of the gains towards the end, but gradually is inching up 0.42% higher on that. Simple moving averages are moving up on 50, 100, 200, and is dropping a little bit on the 20-day moving average. So there is not much of a trend angle to go forward, but hopefully that will pick up. Advanced decline ratio was very flat, I would say today. 283 versus 217, but much better than Friday where we were mostly declines. So advanced decline has uh, improved from Friday, but not really optimally there. ONGC, NTPC were top gainers in Nifty along with HCL Tech, Bajaj Finserv. Some good gains on the side by Reliance, HDFC Bank, ICICI Bank, Titan, Mahindra Mahindra, Tata Consumers, LTIM, and some gains in JSW Steel and Hindalco. So good gains in some of these, no major losses as such in Nifty stocks. Nifty Next 50, however, was a different story where Zydus Life losing 6%. You had Adani stocks losing some ground. You had LIC, IRFC, Ambuja Cement, Zomato all losing ground. And some FMCG stocks are picking up. Dabur, United Spirits, Marico, Kolpal, Godrej CP. Metals and the commodity space also pick up. Jindal Steel and Vedanta. And you also had uh, SRF, Gas Authority, and Chola Finance do slightly better. So mixed bag on Nifty Next 50 and quite green on Nifty. Metals top slot today, 2.2% on metals. Real estate coming back now after a hiatus of nearly a month. Monthly is still minus 3.9%, but 1.8% today has reduced the weekly loss, last 1 week's loss to minus 1.4%. IT is doing well, plus 1.4% here. Commodities up 1.1%, public sector enterprise 1.1%, and so on. Pharma was totally flat, and PSU banks lost another 0.5%. So the loss on PSU banks in the last 1 month is now 4%. PSU banks is the biggest laggard in the market right now. Metals doing well, up 2.16%, led by Nalco 5%, Steel Authority 4.5, Hind Copper 4.2, Hindalco 3.9, and NMDC at 3.37%. Stock spotlight is on JM Financial, which has moved up rapidly today, up 11.8% today. The monthly candle also has recovered very well. Last 3 months has been extremely buoyant in this stock, coming from 65 till about 102. Of course, this stock has been a laggard since 2018, and possibly above this 110, 115 mark, there can be a very explosive rally in this stock, but we are still somewhat away from there. Let's talk about rate cuts and gold. So many asset classes, including gold, of course, real estate, of course, stock markets, are impacted by changes in rate cuts. And what are rate cuts or rate hikes? They are basically tools of the central banker to try and cool off the market or to allow the markets to run wild. So when rates are down, people borrow more. There is more credit. There's more capacity addition. People consume more, borrow and consume, and then uh, as the economy heats up and inflation also goes up because everybody is buying, uh, central bankers want to cool off the economy, and they increase the rate so that people who want to now borrow will think about it again. People who have borrowed on variable rates will get hurt a bit, and they will cut back. uh, People who are going to buy 3 cars are now going to buy 2 cars. People who are going to buy a 5 bedroom house may now buy a 4 bedroom house. So this is how the central banks, it's just like an on off key with them, that whenever they want, they will give that booster to the markets by lowering rates, and whenever they want, they will give a dampener to the market by increasing rates. That is the basic principle. Whether it is working or not is another question and another debate, but that's the tool in the hand of the central banker. So gold also reacts to rate cuts just like all other asset classes, but more so because uh, gold is part of the monetary system, although silently. So gold is sitting in the reserves of central bank for a reason, and whenever you know rate cuts happen, focus moves towards gold in a different way, I'll share with you. So gold will move basis all these different aspects. It's a safe haven asset. There's a lower opportunity cost, inflation hedge. I'll explain all of this one by one. So gold is favored during economic uncertainty. So whenever rates are cut, it means that the government is wanting, the economy is sluggish, and the government wants people to borrow and start the market again, take more risks. And that usually happens when the economic downturn has started, or numbers are bad, jobs data is bad, uh, uh, consumer confidence is down. So when there is uncertainty, a person runs towards gold, that I don't know how stocks will do, how businesses will do in this uncertainty, so let me get more gold. So it's a safe haven asset. Whenever there is uncertainty, whenever there is war, wherever there is specter of the economy not doing well, people will move towards more towards gold. As rate cuts decrease, every dollar is, or every rupee is going to get allocated somewhere, and across asset classes there is a sort of a demand curve, that you know some bond is yielding x%, stocks are yielding y%, gold is yielding z%. So as rate cuts happen, the appeal of other high yield assets comes down. So bonds are no longer giving you that kind of return. So gold becomes more attractive to investors. As a very, very lame example, let's say somebody is going to put money in the bank in the FD, and that was 8%, and now, you know, the rates come down to 6%. So then basically the person will think, why should I put the money in FD? Let me buy gold. It may yield me 10, 11%. So that is the kind of trade-off that happens, that higher yielding assets, when rate cuts happen, will become lower yielding assets, and hence gold will become more attractive. Gold also is known to be an inflation hedge. So as I alluded to this in a few videos ago, over a very long period, if you hold gold, it'll probably buy you the same uh, consumption items as it did 20 years back, 40 years back, 60 years back. So, as an anecdote, in 1980, and this was shared by my father, so I know it firsthand, that a 1 gram of gold in Delhi yielded a five-star, dinner plate. So it used to be some 22 rupees a gram, some 45 years ago, and the plate was 22 rupees at that time. Now it is nearly 7,000 rupees a gram, and a dinner plate in a five-star in Delhi is also 7,000, somewhere near that. Another anecdote which you will see on the internet is about a Armani suit. So, the amount of grams that is required to buy an Armani suit today is probably the same that was there 30, 40 years back. So gold usually, will hedge you against inflation. Your purchasing power will remain intact or slightly improve. That is the nature of gold. So rate cuts can lead to basically inflation, and people may flock to gold to protect themselves from inflation. Another impact that happens because of rate cuts is a weaker currency impact. So let's say there are two countries, and now one country has cut its rate and the other country has upped its rate. Where do you think money will flow? Money will flow towards the country where the rates are higher, or at least the differential is higher. Just like 1 month back when you saw that US was talking about rate cut, but Japanese central bank raised 1/4%. So what happened? Money rushed into Japan and caused the yen to appreciate, right? So a weaker national currency due to rate cuts can also make gold cheaper for foreign investors and boosting demand. So if US dollar cuts the rate and Indian central bank doesn't cut, just for hypothetically, then our currency will go up versus the US dollar, and it will become cheaper to buy USD gold for Indians, for that matter. But it doesn't happen because we follow the US in terms of interest rate policy. If they will cut, then we will cut, so we will stay virtually there only. Economic uncertainty is where investors turn to gold during economic slowdowns, uncertainty driving up value. What has happened interestingly in the last couple of years is that while all this was not there, there was no economic uncertainty as such, there was no rate cut, though in fact rates were rising for the last year and a half. Gold has been steadily rising because it seems that central banks have decided that they're going to buy gold whatever may be the situation, because they have fallen far behind in terms of how much gold they should have in their on their books. So they're buying currently about 1,000 tons a year, which is almost a third of what the global production right now is. So this is a very nice chart I found on Gold Investor Research by Mr. Rutherglen, and he's a master in gold analysis. So this pink line that you can see here is the 2-year uh, US bond. The dark red line here is the Fed's funds rate, and the orange line here is the gold price, right? And this is up till end of 23, so gold price is somewhere around here right now. So what this is showing in the past is that whenever Fed rates have fallen, and there are three instances in the last 24 years. First point of observation here is that the 2-year yields start to fall much before the actual Fed funds rate fall. So here also 2-year yield fell much ahead. Here also it fell much ahead. Here also it fell much ahead, and here also it has started to fall before officially the Fed fund rates have fallen. So this is just a side observation that I would like you to make. Don't wait for Fed funds rate to be cut. Watch the 2 year or even the 10-year yield to know where rates might head. So this is like a precursor to what happens here. Secondly, whenever rates are cut and during the cut, gold went up in this cycle. It also went up while the rates were going up here. So in this cycle, it was going up when the rates were crashing, and it was also going up when the rates were going up. Then when the rates stagnated, gold also remained the same. And once rates started to fall down, gold went up much further. And then when the rate stabilized at bottom, it just sort of stabilized and went into a correction. Then again, when rates fell in 2020, right here, gold broke out and did this huge run that it did. And since then, gold has been consolidating, but now it is slightly above where this mark is. And in mid-September, this is going to fall. The 10-year Fed funds rate is officially going to be announced to fall. So there is likelihood that there will be a decent run up in gold till such time that the Fed funds rate will hit a bottom. Whether they will come down to this near zero mark or will only come down to 3%, that I don't know. Uh, but there is very good likelihood that gold prices will shoot, and probably that is the reason why the first 6 months or 8 months of this year we've seen gold prices already starting to go up, because it is now sort of a given that interest rates cannot rise and they have to fall. What will happen post falling is that maybe they will not fall far enough before inflation comes back again, and then central banks are in a fix that how can we cut more when inflation is already high. So gold is henceforth, the asset class to really have in your arsenal, and minor allocations, 2 4 5 10% is meaningless according to me. Must make good allocations to gold, because the big daddy of the markets, the central banks, are buying, left, right, and center, and that is in public domain. So you need to think, why are they doing that? Is there something that is on the horizon in the next 5 10 years that gold is getting accumulated all over the world? Let me know your thoughts on this, and I'll see you in the next one. Bye.